Todd VanDenburg with VanDenburg Capital Management and the Uncommon Sense Update. Greetings and thanks for watching. So last week the markets were a little mixed. We had the Dow and the S&P were down a little bit when the NASDAQ was up a little bit. Pretty normal volatility, nothing to get too excited about or too depressed about. As we said last week, the market can't go up forever. So, taking a rest, especially ahead of the long Thanksgiving weekend, is probably not a bad thing. Also, what came out last week is that the House of Representatives passed their tax and jobs cut bill. Didn't get a lot of Democratic support, and there was a lot of Republicans who didn't like it too much either. But it did make it through the House, and now the Senate is going to try to pass something, and if they pass something, it won't be exactly what the House passed, so then the two bills would go to committee, and we'd actually see what happens and know what might become law. That's a pretty long, drawn-out process and may not result in any legislation actually being signed by the end of the year, but we're going to watch that pretty closely. Also reporting last week is we've got 95% of the S&P 500 companies have reported earnings, and as of Friday, 74% of them had positive earnings surprises, and 66% of them had positive revenue surprises. Now some people might go, oh my gosh, positive. I tend to look at those surprises as the people who estimate them not being very good at it, because on average, they miss the mark on earnings and revenue like 2/3 to 3/4 of the time. So it's still positive. Positive earnings is a good thing, and so we're pretty happy about that. What we did start to hear last week that was a little surprising is people trying to say that the sell-off in the non-investment grade bond market is some sort of a predictor of future economic collapse or calamity. Now, non-investment grade has another name, and if you see it in the news, you'll hear it referred to as junk bonds. So if they're trying to get you to buy them, they refer to them as non-investment grade bonds, and if they're trying to scare you about them, they call them junk. So there was a bit of a sell-off in the last couple of weeks in the junk bond market, and some experts were saying that might be the predictor of bad times to come. But also reported last week from the St. Louis Fed is through their what they call GDP Now, they're estimating that fourth quarter GDP in the U.S. will grow at about 3.4%. Now, if that actually happens, that's 3 consecutive quarters of 3+% growth, and that hasn't happened in like 13 years. It's been a long time since we've had 3 consecutive quarters of over 3% GDP growth. So if that GDP growth happens, that's more people working, more people buying goods and services, which means more earnings for companies, which means probably that the stock market goes up. So the people selling non-investment grade or junk bonds, you could try to say that that's because they think that the markets are kind of going to come to an end. It could also be because they're selling them because they're junk. Keep that in mind. So as we're following the markets this week, just remember it's a short holiday week, Thanksgiving, and so with shortened weeks comes lower volumes. Lower volumes tends to make things a little more volatile. So just be aware of that as you follow the markets this week. And because we certainly will, we're not going to be making any severe moves simply because we've got volatility in a holiday shortened week. So we hope everybody has a good Thanksgiving. If you like this video, give it a share, give it a like. We certainly appreciate it. And we look forward to sharing more information with you next week. Thanks for watching.